This video is for educational and informational purposes only. It reflects personal opinions and does not constitute financial or investment advice. Trading Forex involves risk and may not be suitable for all investors. Always do your own research or consult a licensed financial advisor. Your trading decisions are your responsibility. Welcome back to Forex Mastery from Zero to Hero. In the last episode, you learned how to recognize what the market is doing. You saw the power of chart patterns, indicators, and trends. But now it's time to put that knowledge into action. Because knowing what's happening is not enough. You have to know how to act on it. You need to master the three most important actions in trading: how to enter, how to exit, and how to manage your risk. This episode is about execution. It's about turning analysis into action, and action into consistent results. This is where many beginners struggle, and where professionals separate themselves with clear, defined systems. Let's start with your entry. A good entry is not random. It's based on logic and structure. Before you enter a trade, ask yourself, what is the direction of the market? Is it trending or ranging? What is the overall context? Are buyers in control, or are sellers taking over? What's the momentum? Is volume supporting the move? Once you know the environment, look for a setup, not just a signal. You want multiple factors lining up. For example, you might see a double bottom forming. RSI is coming up from an oversold level. MACD shows a bullish crossover. Price is reacting to a key support level or moving average. That's not one signal, it's a setup. And that's when you take the shot. Now let's talk about execution. You can enter on the breakout when price closes above resistance, or you can wait for a pullback and enter on confirmation. Breakouts give you early entries, but come with more false signals. Pullbacks offer better entries, but require more patience. One way to avoid fakeouts is to wait for a candle close above resistance, rather than entering mid-candle. This confirms buyer control and reduces emotional entries. Another technique is to look for a break and retest where price breaks a level, pulls back to test it, and then continues. This structure-based approach gives you clarity and confidence. Before you place the trade, you need to know where you'll get out, both if you'd re right and if you re wrong. This is where exit planning begins. The most important exit is not your take profit, it's your stop loss. Your stop loss is your safety valve. It protects your account and defines your risk. Don't place it based on emotion. Place it based on structure. For example, below a swing low in a long trade, or above a recent high in a short. Ask yourself, at what point is the trade invalid? That's where your stop should go. And if you're trading breakouts, stops can be placed just outside the range, beyond the breakout zone. Now comes risk. How much are you willing to lose on this trade? The golden rule: never risk more than 1 to 2% of your account on any single position. This is not about fear. It's about staying in the game long enough to let your edge play out. If your account is $1,000, 1% risk is $10. Use that number to calculate your position size based on the distance between your entry and your stop. This is called position sizing. It keeps your risk consistent regardless of how big or small your stop is. And it prevents you from overexposing yourself on trades that look too good to miss. Let's talk about leverage. Many traders abuse leverage, thinking it's a shortcut to profits. But leverage magnifies both gains and losses. Use it with respect. Even if your broker offers high leverage, only use enough to position size correctly according to your stop and risk percent. Leverage should be a tool, not a weapon. Now let's talk about the take profit. Your target should never be emotional. It should be logical. Look for recent swing highs or lows. Use Fibonacci extensions. Identify key resistance or support zones. Or use fixed risk-to-reward ratios. A common standard is 1 to 2 if you risk 20 pips. Aim to make 40. This ratio is powerful. Even if you only win half your trades, you come out ahead. And if you win more than that, Your account begins to grow with discipline and control. Some traders use trailing stops. A trailing stop moves as price moves in your favor. This locks in profits while giving your trade room to grow. For example, if price moves 30 pips in your favor, you might move your stop to break even. If it moves another 30, you move the stop to lock in 10 pips of profit. This creates a dynamic risk management system. Trailing stops work best in strong trends. In choppy markets, they can trigger too early. But trades don't always go to plan. What if price gets halfway to your target, then reverses? Some traders scale out, taking partial profits at key levels. Others move their stop to break even after reaching a certain profit threshold. These are advanced techniques. They add flexibility, but they also add complexity. If you use them, make sure they're part of your written plan, not something you decide mid-trade. Impulse has no place in risk management. Let's now address a real issue traders face: holding on to losses. One of the most destructive habits in trading is moving your stop loss after it's been set. You're hoping the trade will come back. But hope is not a strategy. Respect your stop. Every time. Treat it as if it were automatic, like oxygen shutting off if the trade goes too far. That's how serious you must take risk control. This brings us to a critical point: psychology. No matter how good your setup is, emotions will try to interfere. You might want to close a trade too early, or hold on too long, or double down after a loss. Discipline is what separates traders who last from those who blow up. One way to stay grounded is to journal your trades. Write down what you saw, why you entered, what your plan was, and how it turned out. This helps you review and improve. Over time, patterns will emerge both in the market and in yourself. You'll see where you shine and where you need to adjust. Another tool is backtesting. Take your strategy and apply it to past market data. See how it performs across different conditions. This gives you confidence and clarity. You're no longer guessing, you're following a process that you've tested. This reduces doubt, especially when you face losses. Because losses will come. No strategy wins all the time. The goal isn't to avoid losing, it's to lose small and win bigger. That's how trading works. It's not about being right. It's about being consistent. A trader who wins 50% of the time but uses a 1-to-2 risk ratio can be profitable. A trader who wins 70% of the time but risks too much or cuts winners short can still lose money. It all comes down to risk management and emotional control. Let's walk through a complete example. Imagine you spot a bullish setup on the 1-hour chart. Price has formed a clear inverse head and shoulders. RSI confirms momentum with a strong rise from below 30. MACD has just crossed upward. The 50 EMA has flattened and price is crossing above it. You decide to enter on the break of the neckline. Your stop loss is placed 20 pips below the neckline structure. Your target is set at a 1-to-2 ratio, 40 pips above the entry. You're risking 1% of your account, and you calculate your lot size to match that exact risk. Price moves in your favor. After hitting 30 pips in profit, you decide to move your stop to break even. The trade eventually hits your take profit. You followed your system, not your feelings. That is execution. And if the trade lost? Same story. You took the loss, small, controlled, planned. You move on. The trade was one of many. No drama, no revenge. You take the next trade with the same discipline. That's how professionals think. They don't get attached to any one trade. They think in series, in probabilities, in process. They know that their edge only plays out over time, through repetition. And that brings us to your trading plan. Every trader needs one. A plan defines your entry criteria, your stop-loss rules, your take-profit approach, your risk per trade, your maximum daily loss, your goals, your mindset strategy, and how you'll review performance. Without a plan, you're just gambling. With a plan, you're running a business. Trading is not about winning every time. It's about sticking to your edge and managing your risk over hundreds of trades. It's about thinking like a strategist, not a spectator. So remember, a great entry without a plan is still a bad trade. A stop-loss ignored is a disaster waiting to happen. A reward not defined is a fantasy. But when you bring it all together, setup, confirmation, entry, stop, target, size, and mindset, that's when you become a trader in control. In the next episode, we take everything you've learned so far and show you how to build your own trading strategy from scratch. No copying, no guessing, just a personalized system that fits your style, schedule, and psychology. Until then, stay disciplined, stay focused, and remember, the best traders don't chase profits, they chase process.